everyone. Welcome to Cigars and Syndication. I'm Robbie. I'm here with my co-host Jay, where we're very passionate about cigars and real estate. And today we're smoking a Tatuaje, and we're gonna maybe expound upon and dig a little deeper into the Rescue Capital.
Hey everyone, my name is Junaid Noor. Thank you, Robbie. Welcome again to Cigars and Syndications. We are smoking this Tatuaje. I think it's called a Coboigon.
That's why I passed on the pronunciation.
Good cigar. We'll review it towards the end of the podcast or the video. But right now, we had a lot of questions regarding Rescue Capital from the last episode we did, and so I think we should dive into maybe. Well, let's summarize what Rescue Capital is a little bit and then dive into the questions. What do you think?
Yep, I know. I think that's a good plan, and we can start with one of the questions, which was maybe the timing of when does the Rescue Capital come into play? Do they deploy it early? Do they hold on and wait? When is the timing? What do you think is going to happen?
So, reading up on what's going on in the market, there's about $52 billion worth of CMBS, uh, the commercial mortgage-backed securities that are just within the state of Texas coming due within the next 24 months. So basically, what happens is, for those of you who are wanting to understand how this works, is that most uh, commercial loans, whether it's a conventional loan or it's an agency loan, well, most conventional loans, let's start with the conventional loans. Most conventional loans are amortized over a 20-25 year period, but every 5 years they come due with a balloon. So basically, what the banks want is, unlike residential loans where you have a 30-year fixed rate or a 40-year fixed rate in some cases, commercial loans are not like that. Most banks want to finance you for 5 years, and then after 5 years, they're going to reevaluate the loan, see where you are, see what the interest rates are, and uh, see how their risk appetite is, and they give themselves that flexibility to re-up the loan every 5 years. And that's where we're saying that, in the next 24 months, billions and billions of dollars just within the state of Texas of loans are due for renewal.
That's a lot of capital. That's a lot of money out there. And when we talked earlier in the previous episode about the Rescue Capital, um, we feel like there's a lot of Rescue Capital out there that can be deployed. Uh, do you think that the banks are going to? I mean, obviously they've slowed down on lending. They've really tightened up, on what projects they're going to fund and not fund. And these current existing projects that have to, you know, either restructure their deal or reach out to Rescue Capital. I mean, do you think that these guys with this capital are going to jump right in, or do you think they're going to wait until maybe there's a little distress?
So the whole objective of Rescue Capital is that the deal has to still be a good deal. So, we're going to start separating or seeing a separation in the deals between bad deals, deals that were bad to begin with, right? You're talking about deals that, they got their 3% mortgage rate, but they had a debt service coverage ratio close to one, 1.05, 110. Um, those are going to be very difficult deals for even Rescue Capital to come in, because they're not good deals to begin with. So Rescue Capital is going to start looking for deals that are cash flowing, but maybe they need some an equity injection to bring the loan to value down, to bring the debt down, in order to refinance the debt. Um, so I think what's going to happen is that the people who are sitting out there with the rescue capital are going to the people in the beginning are going to grab the best deals, and then as we get further and further into the year or into the following year, then you're going to get some people who are going to wind up getting some bad deals. And what winds up happening is that people get greedy, right? So they look at a rescue capital deal and say, okay, you know what, we're going to get 12% preferred. Let's see how we can make this deal work, rather than saying, oh, this deal doesn't work, we're going to walk away from it.
Yeah, and one of the things you hit on last time that I thought was really interesting is how the rescue capital doesn't hit your liability side, and compared to a bridge loan that does. Where's the traps there when you go with a bridge loan?
So, so when you're sitting there and you're needing rescue capital, it's usually because your bank is saying, "Hey, we financed you at 80% loan to value, and now we want that loan to come down to 70% loan to value." Um, and if you go and get a bridge loan, well, that just adds to the liability, just adds to your debt. And so the bank may come back and say, "Oh, wait a minute, you just went and got a bridge loan. Now from 70%, we want a 65% loan to value because you got another loan outstanding now, and the risk becomes higher." So the upside of rescue capital is that it's an equity injection. So it doesn't hit the debt side of the balance sheet. However, the downside is that you're going to be diluting your existing investors because you have this new investor coming in, and honestly, this new investor has a lot of leverage. They are basically coming in to save your deal. So they're going to require a lot more. They may want more preferred capital or preferred returns. They may even come out and say, "Look, you can't refinance without us knowing about it or without us approving it, and sell and buy us out without us knowing about it. You need to have written permission because, we have the leverage right now."
Yeah, I know. I mean, I think throughout the industry, everybody you know is talking about this and how it's going to the current deals and how it's going to impact them and you know obviously there's going to be good deals and there's some deals that their underwriting maybe wasn't the best and there's some unforeseeable things that have happened with insurance and other issues. Um, Obviously, the good deals are all going to be pushed to the front. Rescue capital is going to be there to help them out, you know. But later in the game, and as the deals maybe start getting less attractive, I mean, the rescue capital is still going to be there, but it's probably going to cost them more.
Yeah, and I think you're right about that. It's going to cost them more, and then the rescue capital may want to negotiate a little bit with the bank, let the bank take a haircut, either amortize the loan out further, or take a discount on that loan, just because banks, banks don't want to get stuck with billions of dollars of foreclosed multifamily or foreclosed offices on their balance sheets. They don't want that. They're not in the business of operating assets. They're in the business of lending money. So I think that in the beginning, that the good deals, the deals with some equity on their bones and some good cash flow will get the best and the first rescue capital. And then as we move on, you're going to get deals that are struggling, and they're going to struggle, and the banks will have to do what they did back in the 80s, which is restructure debt. They're going to have to come back and they're going to have to restructure it some way, where either they take a write down on the note or they extend the amortization period. They're going to have to do something, because otherwise you're going to wind up with a commercial version of 2008 financial crisis, where the banks wound up with so many homes on their balance sheets that they don't know what to do with them.
Yeah, and I think the banks are really going to try to avoid that, whether it be residential homes, multifamily, or even office buildings. I think the office building is another issue that's on everybody's mind.
Yeah, well, reading an article yesterday about the federal government wanting to redeploy certain loans. They're not putting in new funding. They're redeploying certain loans to be able to convert vacant office spaces into apartment buildings. Now, I think Rescue Capital would be interested in that, but I mean, you've been in construction. You have a lot of experience in construction. What is it going to take to convert a an office space? And you're not talking about a 4 unit office building. You're talking about maybe a 20 25 unit 25 floor office building into an apartment complex. It can't be that easy.
Yeah, from a construction standpoint, it's not an easy project, and a lot of these office buildings are really large in size, and it's more institutional money. So you're talking about a pretty big injection of capital, with all the different points of plumbing, electrical, all the individual units, the HVAC. it creates quite a mess.
Yeah, no, and we've looked at some of these deals, and if it's a small deal, it's a small office building, it's easily convertible. But some of the larger ones, I mean, I know that San Francisco's got a 30% vacancy in their downtown. Well, it'd be great to be able to convert those downtown offices into condos, but I don't know if anybody wants to live in downtown San Francisco with all the other issues going on with the legal issue, or sorry, the crime and the vagrancies, and when people are not, when office buildings are vacant, the 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 stores that support them, the restaurants and the cleaners and the other ancillary businesses all go away.
Yeah, and it's not that construction can't be done, but you have your entry point into the property, and then you have all of the renovation cost. And does the end result, you know, have a equity position?
Yeah, and at the end of the day, it's going to come down to um, whether you convert those office buildings into condominiums, and then can the buyers afford those condominiums at almost 8% mortgage rates? Right now, the 30-year fix is close to 8%. Or if you convert them to rentals, can they afford the rent? I mean, the rent can only go so high before before your tenants are going to be like, well, I can't afford this.
All that being said, and all the theories and everything. Maybe what do you think? Give it. You were talking about an example of a property and how this rescue capital could actually come into play.
Yeah, so one of the examples that I was sharing with the team was that if for example are working on our development deal for multifamily development, um, let's say we have a conventional construction loan, and now and let's say that conventional construction loan is at 80% loan to value, and now, we're at a stage where the bank says, look, that risk is too high for us. In order to make it into a permanent loan, we want 70% loan to value to convert it to a permanent loan. Now, the question would come that, well, when you gave us a 80% loan to value, it was raw land, and now there's a 300 unit multifamily sitting on it. The bank will come back and say, well, there's no cash flow yet, so therefore the value is not that much more. And you know how bankers are, they want less risk, and they want to loan money when nobody needs the money, and when everybody needs the money, that's when they hold back. So that's where we would go in and get rescue capital to give us that 10% um, gap that the bank is looking for. The rescue capital investors would come in, put that 10% in. It would go on our balance sheet as equity. The bank will get the bank would get that 10% extra. They would be able to pay down the loan to a 70% loan to value. And then we move on and get occupancy done, get cash flow going. And, the rescue capital investors know that once occupancy is there, cash flow is there, obviously based on the cash flow, the building is worth a lot more.
Well, Jay, I don't know what you think about this Tatawahi, but I'm really enjoying it. It's got a lot of flavor. It's a nice, spicy cigar. The construction on the cigar is great. The burns are great. I really enjoying this cigar.
Yeah, no, I really like this Tatuaje. This is the first time I've had this one. So with the yellow label, if anybody can pronounce the name, let me know. But I think it's called a gachos,
Yeah, Capos.
gapos. The thing I've always liked about the Tatuajes is it's not a lot of other uh, flavors that you get. You get a very strong tobacco, kind of like the Cuban cigars, where you get a really good tobacco flavor. And that's what I'm getting with some spice. Not a whole lot of other stuff.
Yeah, it doesn't. The palate doesn't change. It's pretty consistent throughout the smoke, but plenty of good tobacco flavor. I agree. Good burn. Um, I would definitely run out and grab some.
Yep. So, well, we hope you enjoyed this episode of Cigars and Syndications. Look us up on our social media, and post some questions. We'll be happy to answer them, and hope you learned a lot.
We'll see you next time.